Welcome to the CFO Show. I'm your host, Melissa Howitson, CFO of Vena Solutions. We are well on our way into 2024 now. New year, new outlook. But so many of the uncertainties that we had in the last year and a half continue on with us. And as business leaders, we're all wondering, where is this all going? What's going to happen in the economy? Where are interest rates headed? What is the labor market going to look like? Fortunately, we have the perfect guest today to help us unpack it all. Joining me is Benjamin Tal, Managing Director and Deputy Chief Economist for CIBC Capital Markets. He has a finger on the pulse of the macroeconomic environment and great insights in terms of how that's going to impact businesses. Thank you, Benjamin, for joining me today.
Thank you. It's a pleasure.
The world markets seem to be all over the place. You think about differences between Canada, US, Central Europe. Can you maybe give us a bit of insight on what you're seeing happening there? Maybe a bit of a compare and contrast?
Yes, I think that the big difference is between the US and Canada. I'll just give you a few numbers. In the last 6 months, the Canadian economy expanded by basically 0%. We are basically flat. The US economy is expanding by 5.4%.
That's huge.
That's a big difference. So the US is doing much better than Canada, economically speaking, at this point of the game. And the question is why? The answer is very complex, but a few things are happening here. First of all, productivity, which is extremely important. I know that people are not excited about productivity, besides economists, but it's important. Productivity in the US is rising by 3.5%. In Canada, it's negative. So we are not as productive as in the US. That's very important. Another factor is fiscal policy. If you think that Trudeau is spending a lot, try Biden. Biden is spending 3-4 times more than Trudeau, and therefore the government is actually pushing the economy higher. But the most significant force is the sensitivity to higher interest rates. There is a significant difference between Canada and the US. In Canada, we have 5-year mortgages. In the US, the mortgages are for 30 years. So when interest rates go up, in the US, it takes forever to feel the pain. In Canada, it's more immediate. Another factor is you have to go back to 2008. 2008 was the mother of all recessions in the US that led to the mother of all deleveraging. Their debt-to-income ratio in 2008 during the financial crisis went down. Canada, 2008 was not our crisis. We were basically second-hand smokers back then. So therefore, our debt level went up. When you have more debt, obviously, you are more sensitive to the risk of higher interest rates. And that's exactly what's happening. When the Bank of Canada raises interest rates, we feel the pain, especially in the housing market and the consumer, in a much more significant way than in the US. And that's why US interest rates have to be higher than in Canada to reach the same spot. So all those forces suggest that the US at this point is doing much better than Canada. And therefore, we expect the US also to slow down to follow the example of Canada, and that will be a 2024 story.
Really interesting, Benjamin. I knew there were some differences, but I did not appreciate that the list was so extensive. Really some food for thought for business leaders like myself as we think about where we do business and what those impacts might mean, depending if you're in Canada or the US. Or furthermore, for a company like Vena, where we operate in both of those regions, how that might impact how we do business in both of those areas differently. When we think about the fact that for many businesses, one of the biggest costs we have operationally is people-related costs, can you maybe give us some of your predictions on where you see the trends going for that with next year? I'm thinking about things like attrition rates, wage increases, unemployment rates, things like that.
Yes, that's very important because the number one reason why inflation is still elevated is service inflation. And 80% of the cost of service inflation is wages. So if you want to have a narrative about interest rates, about inflation, you must have a narrative about the labor market. And this labor market is actually normalizing in a big way. We have a situation in which we all know the story. We had 1 million vacancies during COVID. We couldn't find people. And most of the vacancies were actually in low-paying occupations. Now, in Economics 101, what they teach you is that if there is a shortage of something, the value of this something will go up. Namely, if you have a shortage of low-wage individuals, their relative wage should rise faster than any other wage category. It didn't happen. Wages went up, but not in a very significant way. So we went to small businesses that employ 80% of those people, and we said, what's happening? And they said, listen, economists like yourself are telling us that a recession is coming. We are not going to raise wages 5 minutes before a recession. And I say, you're not going to raise wages? You don't need this person. You see, it's very easy to press a button and say, I need 5 people. Show me the money. So the fact that businesses did not spend on wages means that in many ways, those vacancies were a bit of a mirage. And guess what? They are dropping like a stone. The number of vacancies now back to normal. If you look at the quit rate, the rate at which people are quitting, it's back to 2019. That's a very telling indicator that the market is normalizing. Therefore, what I'm seeing is a normalizing market that will put downward pressure on wages. It's not that wages will be going down, but the rate at which they are rising will slow down. That's exactly why the Bank of Canada is raising interest rates. The unemployment rate is in fact rising because population growth is faster than employment growth, and therefore the unemployment rate is starting to rise. So the labor market is normalizing, and that's exactly what the Bank of Canada would like to see in the future.
You mentioned an even greater focus on profitability in the future. I think as business leaders, there are many who think that they've already been pivoting towards greater and greater focus on profitability in the last year. And so when you think about the fact that it may even get harder in the future, I think for business leaders, what that tells us is we need to buckle in. This might be a longer ride than we thought. There's lots of talk about artificial intelligence and some of the impact it's going to make. When you think about it from where you sit, looking at, the impacts that may have on economy and labor markets, any thoughts there?
Yes. First of all, we have to put things in perspective. We have to realize that if you ask yourself to what extent COVID was an event or a condition, I suggest that economically speaking, COVID was a condition in a way that it accelerated many trends that started before. This means that corporations are facing a new reality. We have to realize that 4 things are happening in a very significant way. All of them are negative for profit. Profit was easy over the past 20 years. In fact, profit margins are already at record high. So we have a situation in which all those forces are now acting to put downward pressure on profit margins. Those include deglobalization. We used to have globalization that was good for business. Now it's deglobalization. We used to have just-in-time inventories. Now we have just-in-case inventories, bad for profit. We used to have a labor market that was very giving. Now it's very tight. And of course, all those green initiatives are negative for profitability. So 4 major forces that are putting downward pressure on profit margins. So now you are a CEO of a company. You have 2 choices. One is basically just pay. The other is do something about it. They will do something about it. And this something will be to replace capital or to replace labor with capital. And that's where AI enters the story. AI will be a very important factor in the near future, suggesting that we are going to see a different behavior when it comes to corporate Canada. Now, when it comes to AI, I think that it's a very typical case in which people are overestimating the impact in the short term, underestimating in the long term. People worry about their jobs and to what extent AI will replace their job. Clearly, there will be some people that will feel the pain, but I think that the way to understand AI is that the person that will be using AI will be replacing you, not the person that is using AI in an ineffective way. I think that's the way to look at the situation. And therefore, I suggest that this is a major change in the way we do business. Productivity in Canada will have to rise because profit margins will go down, and that's something that will ignite a wave of productivity the way we have seen in the 1990s. Unfortunately, some people without the appropriate education and background will feel the pain, and that's where you need the government.
Lots of great food for thought there for businesses that may be thinking about investing in AI. It's interesting because you talk about some of the time horizons that we may be overestimating for the near term and underestimating for the long term. I definitely think that there's a lot of focus on the near-term impact, but you definitely make me pause and think that we've also got to think about that longer-term horizon and what that's going to mean over the long run. If you think then about inflation and how it affects some of the other costs, we've talked a bit about labor, but what about costs outside of labor? What do you see happening there in terms of businesses over the course of 2024?
Inflation went down from 8% to 3%, basically over the course of breakfast, without much economic damage. And many of the inflationary forces that we have seen over the past year are now becoming disinflationary. All the forces that we were talking about, corporate profitability, are also impacting inflation in the long term. But in the short term, what we are seeing is a few things that are actually disinflationary. One of them is the commodity market. We have to remind ourselves that, of course, when we go to the supermarket, we are all overwhelmed by how expensive things are, especially food. But remember, inflation is a rate of change. It's not the level of prices. So the Bank of Canada does not care about the level of prices, how expensive things are. They care about to what extent they rise further and by what speed. And if you look at food prices, for example, if last year they were rising by 8% and today they are rising, but only by 4%, that's actually disinflationary. Supply chain was a major inflationary force until recently. Now supply chain is back to normal. This means that prices are actually going down. Prices of goods are going down because you don't have the supply chain issue. And in fact, goods prices are negative. They're going down. Also, when supply chain is an issue, all the inflation that is coming from outside the economy. This means that the Bank of Canada does not have the power to impact it because, believe me, Putin does not care about the fact that the Bank of Canada is raising interest rates. And then you have profitability. Let's face it, many retailers during COVID were hiding behind the fog of supply chain. You went to the store, you asked for this dishwasher, and they said, supply chain, Russia, China. But if you add a little bit of more money, we'll find one for you in the basement. There was a very high correlation between supply chain and profit margins. Now supply chain is back to normal, profit margin are actually zero. This is a major underrated disinflationary force. So all those forces are disinflationary that will lead to some improvement in the inflation story over the next 6 months. I believe that the Bank of Canada will be able to reach the target of 2% by mid or late next year.
And so if we think about that and turn into then, what does that mean for interest rates? Are we looking at some relief coming in 2024? And what about thoughts beyond into 2025? Where do you see interest rates going?
Yes, I think that the Bank of Canada is done. I think that at 5% overnight rate, Bank of Canada rate, the Bank of Canada is done. So the question is, when are you cutting? I think they will start cutting in May, June of next year. So we still have about 6-7 months to live with those extremely high interest rates before they start cutting. The question is by how much? We started this saga at 175. We are at 5% now. We stayed there for a while. We go down to, I say, about 275. Maybe 3. So significantly higher than before. All those forces that are influencing profitability are also impacting inflation. Deglobalization, just-in-case inventories, a labor market that is not giving, green initiatives, they're all inflationary. The target is the same, 2%. More inflation, same target. Clearly, interest rates have to be higher than they were before, and that's a good thing because this economy can function beautifully when the Bank of Canada rate is about 2.5%, 3%, because it's the right number. So I think that, again, to summarize, 175 before the crisis, 5, we stay at 5, we go to about 275. About 150 basis points of that cut will be in 2024, and the rest will be in 2025.
Related question, because we saw over the last couple of years, we used to have great access to capital, and then it started tightening up along with interest rates rising. Where do you see some of the capital markets going and the impacts that this will all have on access to capital for businesses?
The first 6 months of next year will be a bit difficult. The economy will expand by 0%. Basically, access to capital will be difficult. It will be semi-recession, maybe a recession. However, the minute the interest rates start going up, and they will go up, especially the 10-year rate, we will see a situation in which access to capital is starting to improve. And I see most of the improvement happening in 2025. So I believe that we still have to go over the next few months. We have to tolerate the pain because it's not going to be easy. It's going to be semi-recessionary. But the second half of 2024 and into 2025 will look much better.
Are there any new themes or trends that you see emerging as we head into next year? Things that might surprise us and that you think that business leaders should be paying more attention to?
Yes, I think that the negative impact on profitability is something that people are not ready for, quite frankly. I think that profit was very easy over the past 20 years, and corporations got used to it. I think that will be something that will have a negative impact on profit. I think that the labor market beyond the next few months will be very tight, something that corporations will have to deal with as well in terms of higher wages or increased productivity. I think that the lack of productivity growth has been a major force because profit was easy. That is going to change now. I think that companies that will not focus on productivity and technology will lose. So a lot of things to think about.
Certainly an exciting time to be running a business or thinking about where to take things next year when you're making your business plans. Ben, thank you so much for joining us today and sharing such amazing wisdom and insights that you have. Now, whenever we have a guest on, we do like to ask them 2 rapid fire questions. Are you ready?
Okay.
All right. The first one is, what is the best piece of business or leadership advice that you've ever received?
Be optimistic.
Great advice. Absolutely. Especially where we are now and where we're looking to go with the economy. So love that one. And what is the most impactful book that you've ever read?
Well, there are so many, of course, but Thinking Fast and Slow is a very significant book that I read recently. I love the book. It tells you really how to think and what not to think, and how things are shaped by the psyche and how you can impact the psyche of people in a very significant way. So this is a great book, highly recommended if you haven't read it.
Excellent. Love that book too. So that's a good one. Benjamin, thank you so much for joining me today on the show. Really valuable insights that you've shared with us.
Thank you very much. I really enjoyed it.
If you'd like more information about today's episode, please visit the links in the show notes. And don't forget to subscribe wherever you listen to or watch your podcasts because you don't want to miss an episode. And if you like what you saw today, please leave us a review on any of the streaming platforms. We love to hear from you, and it helps other listeners to find the show. For the CFO Show, I'm your host, Melissa Howitson. Until next time.